let's start out with CPI for the month of September, up 0.4 on headline, double the expectations, and that is the highest since, well, June, when it was at its peak at 1.3. That was the highest since 2005. If you strip out the all-important food and energy, also 0.2 hotter, up 0.6. That's the hottest since June, when it was up 0.7, high water mark all the way back in April of 21, at up 0.9. Year-over-year numbers, 8.2, hotter than expected, but cooler than the rearview mirror, 8.2. Until we get a revision, it follows 8.3. The high water mark here was 9.1. That was in June, going back 4 decades. And finally, year-over-year, strip out food and energy, also hotter than expectations, up 6.6. That follows 6.3, and 6.6 is a new high. The old high was 6.5 in March. That went back to 1982. But in 1982, we went all the way up to 9.3. So even though it's a new high water mark, it doesn't change the comp back 4 decades to 1982. If you look at yields, they are just skyrocketing. We're almost back up to 4% in 10s. Now let's go to initial jobless claims, 228,000. That is up 9,000 until we get a revision to the 219,000. And on continuing claims, 1,368,000, darn close to expectations. Very close also to the rearview mirror, 1,361,000. But we can really see the yields have shot up here to 4%. And if you look at what's going on with regard to 2-year note yields, they're all the way back up to 4.32. So this is a hot number. And with the expansion on that 6.6 on the core, and we all know it's about food and energy, this is definitely going to pique the ears of our central bankers domestically and globally. It's going to make the dollar index much hotter, and it may also complicate some derivatives that you were talking about earlier. I used to run a derivatives products group. There's 2 things you can't control. What we call discontinuous volatility. When gilt prices and yields get crazy, you can't make your periodic adjustments that you need to make. And option volatility. There's no way to compensate for gap jumps in option volatility. If your models are replicating your pattern of payout based on options, volatility moves up or down in a dramatic way. There's very little you can do about it but take a hit. Becky, back to you.
Take a hit. That's what we are seeing in the markets right now. Rick, stay with us, but let's run through these boards. Right after this number that was hotter than anticipated, you're talking about up 0.4% month on a month-over-month core. Ex-food and energy, you're talking about CPI up 0.6%. That's 0.2% hotter than expected. We immediately saw a massive shift in the futures markets. The Dow futures now down by 300 points. We'd been up by about 300 points before, maybe up 250. NASDAQ is indicated off by 276, and the S&P down by 58 points. If you've been watching yields, this is a real story, too. The 10-year, I saw push above 4% on this. It's sitting right now at 3.977%. The 2-year at 4.43%. Very significant moves, completely reversing what we'd heard on this expectation, these kind of rumors that are out there that Liz Truss's government might reverse. That calmed down yields earlier across the globe. But this is a whole new thing.
Go
because
buy your
this is an expectation of what's going to be happening with the Fed not able to take the foot off the gas at this point, continuing those rate hikes. Let's bring in our panel at this point to talk more about it. Betsy Stevenson is a University of Michigan professor of economics and public policy. Nancy Davis is the founder and chief investment officer at Quadratic Capital Management. Neela Richardson's here from ADP, where she's the chief economist. We've got Steve Leisman and Rick with us, too. And, Steve, just take us through these numbers, the things that really jumped out. What caused this higher inflation?
It is where exactly I told you it was coming from at 8 o'clock, which was the service sector. You had a big rise in rents, but even you take the rents out, everybody says that's a lagging indicator. There is just nothing in here to tell you that there's reason for the Fed to pivot. And I can tell you right now that one number here that is maybe the most significant. I've not seen this number before. Rick will either back me up or shoot me down. 483 on the peak funds rate, April 2023. I'm just making sure that's the high water mark. Yes, it is. April 2023, we were at 468 going into this 469. We've not seen a new funds rate now, 483. And again, nothing in here. Everything the Fed, look, they have been medium term to long term wrong.
Yeah.
Short term, they've been right when they've been coming forward. And you had Mester, who took a little heat the other day, saying you can't even say inflation has peaked yet. Well, you can't even say inflation has peaked yet, at least in these numbers. We can argue about whether or not the Fed's watching the right numbers or not, but you look at the panoply of service sector numbers in here, and you see them rising. There has been a little bit of relief on the good side, where the commodities less
Is there
energy.
any sign that with the Fed